Well, that was interesting with US CPI data, and pretty much exactly as we talked about when we convened here yesterday. This is Macro Money, of course. I'm Ilya Spivak, head of Global Macro here at tastylive. And we've just had the biggest piece of macro event risk for the week go into the rear view with about exactly the performance that was expected. Markets saw the slightly higher inflation number, saw the less lower than anticipated core number, and said, well, this doesn't append Fed rate cut odds. Good. And so initially stocks wobbled and the dollar had a bit of a better session, and then everything reversed into the close because the markets seemed perfectly happy to say, well, if this doesn't change Fed policy odds, what has actually happened? Perhaps not much. And maybe setting the stage for a replay of some of the dynamics we saw in November and December. But what that gives us here as we close out the week is an opportunity to dig a little bit deeper and to have a look at something that we try to update once a year, have been updating once a year, and that's a framework for understanding how the US dollar works and what that says both about economic growth dynamics in the US and globally, as well as monetary policy dynamics, relative country performance, relative asset performance, because, of course, when we talk about the dollar and how it's doing, we're talking about how money is doing and what the cost of money is doing. And that is, of course, a foundational element to any kind of thinking about any kind of market anywhere. Because before you do asset selection, you must first decide, well, am I even going to spend money to invest? What's the cost of spending it? And so what we're going to look at here is going to be dollar as an asset focused, but at the same time, it is going to offer, hopefully, a window into the underlying dynamics of money and what that means more broadly for the markets, especially as we head into this new year. So we'll start here with, of course, the operative question. What is going to happen to the dollar in 2024? Why? And we're going to start with a jump-off point that is famously called the dollar smile framework. This was developed by economists Stephen Jen and Fatih Yilmaz, and it tracks the performance of the U.S. dollar relative to how the U.S. economy is doing compared with other major economies. And if this seems like a mouthful, just wait. We're going to unpack all of it piece by piece. What the model finds, and this is the key upshot here, is that the dollar does well when the U.S. is doing much better or much worse than the other major economies. It tends to do least well when U.S. performance is kind of middling, when the U.S. is about near the average. So let's take a look at what this looks like. Here we go. What we see on the y-axis of this chart is the U.S. dollar. In this case, we're using the DXY future, so the U.S. dollar index future. That's this right here. What we have here is a GDP growth spread. So what we're saying is how much is the U.S. either underperforming or outperforming relative to an average of other G7 countries, and the variable is annual GDP growth. So, for example, over here where it says 1, this would be the US is growing 1% faster in a given year than an average of other G7 economies. And just for reference, when we are saying, well, what are these G7 economies? We're talking about Canada, the UK, Japan, Germany, France, and Italy. So Japan plus sort of the most influential economies of the Eurozone plus the UK. So here's the zero line. On this side of the equation, the US is underperforming. And what we find is, for example, instances like this, where the US is outperforming, is growing faster almost by 4%, and the dollar is stronger relative to other major currencies. But also when the US is underperforming to the tune of about 2.5%, we again get a stronger dollar. And so when you do a kind of approximating line here through this scatter of data points, what you find is something that looks vaguely like a smile, which is why this is called the dollar smile model. Now, why does this happen? Why does this seemingly sort of strange dynamic occur? Let's take it piece by piece. The right side of the chart should make perfect sense. And this is the way that currencies generally work. If an economy is performing well, if there's growth that's accelerating, that generally tends to be inflationary. Because, of course, more money is changing hands, more people want to be buyers of stuff. That creates demand for the stuff. The price of stuff goes up. Now, the central bank, of course, has an inflationary mandate and says if inflation gets beyond a certain point, we have to raise rates. Central banks are, of course, forward-looking. So as they anticipate inflation, they begin raising rates, and the markets are forward-looking. And as they anticipate the Fed's anticipation, they begin buying the relevant currency because what they're expecting is that the yield on owning that currency will go up and confer a greater return, a greater income stream, much the same as a dividend yield on owning a stock. It is a separate income stream from whatever the price of the asset might do or not do. It's essentially just a flow of payments. And it's not difficult to understand how this happens. Currencies are yield-bearing instruments, much the same as stocks and bonds are. Why? Because one person's cost of borrowing is another person's income from lending. So if I have $10,000 that I'm not going to use on something and that I don't want to keep as cash so that I could use it on something, the easiest way that I could make that money turn into more money is to lend it. And if interest rates go up, I can lend it for a greater interest rate. And if I then anticipate that a given currency's attached interest rate is going higher, I'm going to want to own that currency because I can then lend that for more than perhaps some other currency. So in very kind of simplistic terms, when you get U.S. outperformance, what you get is ostensibly more inflationary impetus to raise rates in the U.S. than elsewhere. And so a widening of yield spreads in the dollar's favor and a stronger dollar. This is the same way that it would work if growth in Europe was outperforming, or the UK, and you were expecting widening yield differentials and the benefits of those currencies. This is FX markets 101. This is how currency markets generally find a way to go up or down. This is the bedrock for why currency markets do anything. And of course, we saw this in spades in 2022 in the meat of the Fed's rate hike cycle. This is a chart we've seen before. It relates policy change in 2022 amid sort of the meat of this last rate hike cycle. That's this right here, with the currency's performance that year. You can see, of course, in 2022, the U.S. had the most rate hikes here and the best performance here. Japan had the least rate hikes, none, and had the worst performance to show for it. And then, of course, there's a bunch of economies in the middle. So that's the simple part of this story. Now, let's consider what's going on here. Why is it that the dollar tends to do well when the U.S. economy is underperforming? Well, this is where we get to something that other currencies don't tend to do. But the dollar does because it is so very special. Now, what makes it special? Well, here's another chart we've seen before. This one comes from the Bank of International Settlements. This gives average daily turnover for most relevant currencies. I put a collective bar here in red for the BRICS because, of course, there's been recent talk about maybe the BRICS displacing the dollar. And so I just wanted to point out here how ludicrously ridiculous, there we go, that argument is. Because the kind of turnover that you would need, the capacity for the kind of turnover that you would need to replace the dollar is so thoroughly absent from any of its competitors that it really is unique. And replacing it is, at least in any kind of foreseeable future, utter fantasy. So consider here then that about 88% of net daily turnover in the global currency markets is settled in the dollar. There's just not even a contest. And what this does is it makes the dollar uniquely liquid. Now, what happens in an environment where the U.S. economy is vastly underperforming? Well, it isn't just any economy that's vastly underperforming. It is the world's largest economy. So we can see here, based on the World Bank estimate as of 2022, we don't have data for last year just yet, the U.S. is 22% of the global GDP pie. The Eurozone is about 12 and China is about 16. So between the three of them, they are 50% of global GDP, with the U.S. being the largest. An additional caveat here is that most of the ones in the rest of world, 50%, look to the other three for demand. They are largely vendors. Second caveat here is that China, being a kind of middle of supply chain economy, is also a vendor and looks to the U.S. and the Eurozone for its demand, which is part of the reason why China has been so anemic despite having reopened from COVID lockdowns in late 2022. Because supply chains have shifted and the demand is not there like it was before the pandemic. So in an environment where the US is underperforming, what we're saying is that, number one, the world's largest economy is underperforming. And number two, its influence is even more outsized than it seems because it's actually more influential than its 22% share of global GDP, because much of the rest of the world and China are dependent on it. And growth there falls off if growth in the US does. So, in an environment where the US is meaningfully underperforming, like here, 1%, 2%, what do we think is happening to global growth? It's probably doing very poorly because its main engine is misfiring. What does that mean to cyclical assets like, say, stocks or commodities that are anchored to the global business cycle, like crude oil, copper? What does it mean for, in general, things like corporate bonds, which might have a cyclical element because, of course, companies' ability to repay debt is a function of their capacity to generate earnings to some extent. And if there's a global downturn, well, then the purse strings tighten everywhere, as do belts. And so what we have then is a kind of risk-off dynamic where the markets get defensive. People start to liquidate assets that are anchored to global growth because it's going the wrong way. So when they liquidate, where do they go? Well, they cash out. Fine, but what's the cash? Are they cashing out into euros? Are they cashing out into the Brazilian real? Of course not. And it's because of this. Because the dollar's unrivaled liquidity means there is also many, many, many more buyers and sellers at every level, which means that there is much more capacity to absorb large capital flows out and in without a lot of volatility. And if you're going to be cashing out because you're concerned about volatility, well, the last thing you want is to cash out into a volatile instrument. And the least volatile is probably going to be the most liquid. And the most liquid is the US dollar. To put this another way, here's a sense of market size, just to understand just how deep U.S. markets are and therefore why they are such an attractive venue for safety-seeking capital. And I've pointedly left out derivatives markets and others because, frankly, that would just be unfair to markets outside of the U.S. Things would be so much more skewed. But instead, I've just kept it to stocks and bonds. So if you look at market capitalization, market size for stocks, for bonds, and the two together, again, the U.S. towers conclusively above everybody else. And so, of course, the cash out venue in a crisis, in a panic, is going to be dollars because they are so liquid and therefore probably the least volatile and the most forgiving as far as going in and getting out. If you spot the panic anything later than the absolute beginning, if you are not first and you are cashing out into something illiquid, well, by the time you arrive, it's already been driven up. And when the panic ends, you better be first to exit. Otherwise, by the time you do, it's already being driven aggressively down by capital flows coming out. So, unless your timing is absolutely clairvoyant in its perfection, If you are cashing out into something illiquid, you lose money going in, you lose money going out. Those kinds of wild swings are mitigated with liquidity, and the US dollar's liquidity is second to none. And that's why we have this dynamic here. Now, needless to say, the next interesting part of this conversation is, well, that's all acute theory and all, but how does it work in practice? And the first thing to keep in mind here is that these two sides of the equation need not be exclusive. It need not be one or the other. Elements of both can exist at the same time because, of course, it's a long year. Markets move up and down. There's overlay and there's sequencing. So let's superimpose the numbers for relative performance of the U.S. compared to the G7 economies on this framework and get a sense. So first and foremost, note there are asterisks next to 2023 because we don't have those finalized growth numbers, so those are forecasts. That's based on forecasts. The year is, of course, over already, so they're fairly good forecasts, but forecasts nevertheless. Numbers for 2021 and 2022 are, of course, hard numbers. Consider first 2022. Here is a year where, on the one hand, you get a vast U.S. underperformance relative to the G7, almost 1%. And so you have a risk-off impetus for the dollar. But of course, at the same time, we know that this is going on. The Fed is in the midst of its aggressive rate hike cycle. So when we look at what's going on in 2022, we're looking at both sides of the equation. So yes, the Fed is raising rates. It's raising them quickly, and it's widening out the yield differential in the dollar's favor. At the same time, stocks are falling. All of that is creating support for the dollar across both sides of the dollar smile here. So consider in 2022, the S&P 500 was down almost 19%, whereas the dollar was up almost 8.6. And that 8.6 was incidentally the biggest since 2016. So a very spirited advance. Now consider what happens in 2021. That's a bit of a different year. You still, in 2021, have dollar upside, but it's much more modest, about 4.5%. In that same year, the yield differential story is in some ways a wash, although the US dollar is starting to pick up a little bit in the second half of the year on the idea that the Fed is in fact getting ready to tighten. The signaling starts to come out. So you get a bit of something on that part of it. But on the risk side of it, 2021 is actually a very good year for stocks. S&P 500 is up almost 27%. And so you get a kind of positive dollar response, but not altogether positive, because yes, there is a good story here for yields. The hikes haven't started yet, so it's not runaway conviction. And there isn't really a bid on the dollar from liquidation because people aren't liquidating. They're buying risky assets. And so what you have is a modest rise, matching with sort of modest growth differential. But if you looked at the growth differential alone, it wouldn't really tell you much here. Now consider 2023. This is a year, again, where the dollar hasn't done anything terribly complicated or terribly convincing. It is down 3.1% on the course of last year. Now, this is where things get really, really interesting. We still have rate hikes out of the U.S., but they're, of course, slowing. And by the second half of the year, you start to get expectations of cuts. U.S. growth outperforms by a very significant 1.58% if you look at the forecasts. And again, that's a forecast, but let's say it's anything like 1.3 to 1.7, 1.4 to 1.7. Either way, it's a significant outperformance. But the story on rates is starting to change. And so you still have a situation here where rates matter. The more policy change you get, the better the currency does generally. But you also have a situation where things are starting to evolve. And the story is getting more mature. The upshot here is that you need the U.S. economy to outperform by a lot to get the dollar to really go. And you need the U.S. economy to underperform by less, relatively speaking, to have the same thing happen. So you'll notice here the range of upside options goes out to a 5% positive differential, but only a 3% negative differential. And that's because the U.S. economy is so commanding that its outperformance leverages the entire global economy, and there are other options that maybe are growing faster, where inflation is greater, and so rates are going higher. This general risk-on environment created by moderate U.S. outperformance waters down the dollar's appeal. But even a little bit of U.S. underperformance is so damaging to everything that you don't need as much on the downside to get liquidation going as you need on the upside to get people to want to buy dollar for yields. You'll also notice the right side of the smile, steeper than the left side. So you only need a little risk aversion, a little liquidation, but a lot of outperformance to get the dollar to really go. And this is where we turn to expectations for next year. What does all this mean going forward? Well, we find here that we have a set of forecasts that's basically middling. We get a little bit of outperformance, but not even 1%. About 0.8% in 2024, less than 0.5% in 2025. That should be consistent with a generally weaker dollar, where the global economy isn't falling apart, but the pressure on rates isn't great in the U.S. relative to elsewhere. You might get more of a supportive situation outside of the U.S. on the rates front. And so you have a kind of slow and steady environment, which should, while not triggering liquidation, based on these forecasts anyway, should direct you outside of the dollar in this kind of slow but benign sort of an environment. This very conveniently lines up with what we've been talking about vis-a-vis policy expectations, where we can see here that if it continues to be where there is the most rate hikes or the least rate cuts is where the currency will perform best, and vice versa, and we rank the major currencies on that basis, the Japanese yen stands tallest, not because there's going to be a ton of rate hikes, but because there's not going to be a ton of rate cuts. Whereas the US is toward the bottom of the list. Lots and lots of rate cuts expected. A little bit more in the Eurozone, but we can see significant clustering here with North America and Europe toward the bottom of this list. So the story on rates seems to agree with the story on relative growth expectations that it's shaping up to be a bad year for the dollar. With one caveat. As we've said before, history since really the advent of the current financial and monetary order in the wake of the end of the gold standard and Paul Volcker's aggressive disinflation in the late 70s into the mid 80s, what we have is a pattern where just about 2 years after the start of a rate hike cycle, there is some kind of a volatility surge. COVID, of course, is a bit of a freak occurrence here, but everything else clearly seems to follow something of a pattern. And so what we find then is we're right in the window for something like this to happen. So on growth and rates grounds, the dollar does not look like it's in very good shape. But if there is some kind of a surge in volatility that then drives liquidation, well, then we end up on this side of the ledger, and the dollar soars. And that's what 2024 is looking like as we get started. That's Macro Money for today. Thanks very much, as always, for joining. We're here every Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, talking about what happened on Wall Street on a given day and where that may set the road ahead. I'm back on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights portion of tastylive.com, opining on Twitter, or the platform formerly known as @IliasPivak. Thanks very much once again. Happy trading. Macro Money will be back next week. Take care.